How do you lose money on a real estate deal when you have seller financing at 0% interest? It sounds impossible, right? No interest means maximum profit. Well, I just sold 50 Madeira, a property that I had held for almost 5 years. I had the perfect loan. I collected nearly $70,000 in rent. And yet, when I walked away from the closing table, my net profit was less than 10 grand. And worse, once the IRS gets their cut of my depreciation recapture, I will have essentially worked for 5 years for $0. Today, I'm going to show you exactly how maintenance costs and exit surprises can kill even the best financing in the world, so you don't make the same mistakes I did. The trap was set in 2021. I put $39,000 into the deal between the down payment and immediate repairs. But every year, right when I thought I was finally getting ahead, this house had another surprise waiting for me. 2023, the well failed. If you don't know, a lot of Florida properties outside of city limits run on private wells. And when they go, it's not cheap. That was $10,475. $10,000 on a well. But I thought, okay, that's 1 year of profit down the tubes. 2024, the roof reached its end of life. Another $89.75. Another year of profit down the tubes. 2025, constant plumbing and mechanical issues. Another 10 grand or more. And this doesn't even account for my insurance premiums, which if you own property in Florida right now, you already know have been through the roof. I was spending 80% of my gross rent just keeping the building standing. We only felt profitable because the 0% interest loan meant every $400 mortgage payment was building equity. But that equity was just a savings account I was forced to fund to cover the house's failures. Now, if you think the maintenance was bad, wait until you see what it cost me just to sell the house and the tax bill the IRS hit me with after. That's the part nobody talks about. When the 5-year balloon was coming due, I ran the numbers on a refinance. At 6.5% interest, this house would have lost $184 every single month. The asset just couldn't support market rate debt. So I decided to sell. But to get it sold to a new homeowner at maximum value, I had to dump a fortune into it. $9,500 for new windows because the old ones were shot. 9 grand for electrical to bring the house up to safety codes. 10 grand for a new bathroom, paint the inside and outside of the house, and to clear some overgrown trees just so the buyer could see the lake. Because in Florida, a lake view is what gets you top dollar, and mine was completely hidden. That's 29 grand in exit costs. Now, listen closely. I'm a realtor, but I sold this off market with 0 commissions. I saved myself $13,800. If I didn't have my license, that $9,500 profit becomes a $4,300 loss. This deal would have officially been underwater. But here's the final nail in the coffin: the IRS. To lower my taxes while I owned the home, I claimed about $44,000 in depreciation. It felt like a win at the time, but now that I've sold, the IRS is coming for depreciation recapture. By the way, it doesn't matter if you claim depreciation or not. The IRS assumes you did and charges the recapture anyway. Don't think that not taking the deduction means you don't pay the recapture. At a 25% tax rate, that's an $11,000 tax bill heading my way. That bill hasn't landed yet, but it's coming. And when it does, my $9,500 profit is gone, burned up in taxes. After 5 years of managing tenants, chasing contractors, and clearing brush, I'll effectively have broken even. Don't let 0% interest blind you. A bad house with good terms is still a bad house. Here's a few tips. Number 1, analyze every deal at a 7% interest rate, not whatever creative financing you negotiated. If the property doesn't cash flow at market rates, you don't own an investment, you own a liability. Number 2, account for exit repairs. You can't sell a rental grade house for top tier prices. Number 3, plan for recapture. The tax man always gets paid. And if you're buying your first home in Florida, these same maintenance realities apply to you. Get a thorough inspection and budget for the worst. Now, here's the crazy part. After everything I just showed you, I just bought another property on similar terms. 1925 Laredo Drive. $216,500 purchase price, 36.5 down, 0% seller financing. But this time, I'm playing a little different game. This house needs about 23 grand in repairs to be rent ready, and it should rent for $1,850 a month. The difference? I negotiated a 10-year balloon instead of 5. By the time that balloon comes due, I'll only owe around 70 grand. At that balance, it should be easy to refinance and keep cash flowing, even at market rates. Same terms, smarter deal. I'm going to document the whole thing so you can follow along and see if the lessons from 50 Madeira actually stick. Subscribe so you don't miss it. This has been the Florida Real Estate Insider. I am still Tom McNamara. I'll see you in the next one.